All right, here we go. Just a couple minutes late as people continue to log in. We're going to go ahead and get started. And welcome to our first SEM University of 2025. And I just wanted to let everybody know, get the preliminaries out of the way. If I happen to mention any investment performance, just remember past performance is not a guarantee of future results. Everything involves risk. This is definitely not financial advice. The purpose of this is just to give you an idea of what we're looking at. And if you've been around SCM for very long, what you will know is we do not like making forecasts because it really doesn't serve us a purpose because we're built to base our decisions on data and history and not guess what's going to happen and try to anticipate that. But one thing that I read as we were getting ready for this was from John Malden, somebody that I've read for the last 25 years, maybe 30 years by now. He's an economist who puts out a weekly letter, and he does a forecast every year. And he said, I like this quote here that I put on the screen, that thinking about the future is an exercise because it's not knowable, but it helps us think about the process. And the way I think about it is if we can imagine what could happen, we can think about what we would do if that does happen. So I want you to think about that as we go through. We've already had some people ask questions ahead of time when they registered for the webinar. We do have the Q&A button there at the end. What we're going to try to do, and this is a very, once again, heavily data focused presentation that now we have about, what, 27 minutes to get it all in. I want to respect everybody's time, whether you're just having your first coffee break on the West Coast or you're at lunch here on the East Coast. At the end, then we'll open it up for Q&A to also, answer the questions that came in as well as the other ones. So let's get going and try to cover all the things that we promised we would talk about in less than 30 minutes. First off, let's think about the agenda. And back on January 5th, President Trump basically put out on Twitter or X or whatever we call it now. I don't know, it's a tweet. It was what we used to call it, so I don't know what you would call this, but basically he gave us the agenda. And if you want to summarize, what he wants to do is secure the border, boost energy production, renew the tax cuts, and oh, by the way, tariffs will pay for everything. We don't even need to worry about balancing the budget because tariffs are going to take care of it. Another thing that's really been really hard to do with President-elect Trump, and we knew this from his first term, is he made a lot of campaign promises. And Axios and a couple other news services went ahead and broke down those promises that he made on the campaign trail. And they based it on the size of this is basically how many times he mentioned it. And so we're not going to obviously go through each of them, every one of these, but I want you to keep this in mind of he has a very large agenda and a short amount of time to do it. And so we're not going to be able to get all of these things accomplished. And actually there was even more promises that he made. And you could see, the fine print there for me to get it all onto one slide. There's a lot of things that he promised to do. The other thing he's promised to do, and this was one of the things we wanted to talk about as one of our key bullet points, is because January 20th, next Monday, we're recording this on Thursday, is he has said, and I don't know if he was serious or not, he wants to do 100 executive orders on day one. He even joked that he's just going to have a small desk on the Capitol steps and he's going to start signing. And one of the things I think people need to understand is what an executive order really is. Essentially, if you think about it, it's a directive to federal officials or agencies. For example, he can say to the Department of Transportation, I want you to start enforcing this law heavier. Or he can go to the Department of Treasury and say, I don't want you to enforce financial crimes as much anymore. He can basically tell his agencies and his officials what they should or should not focus on. And some of those can take effect that day. Others, based on the rules for that agency, might have additional time worked in. So a lot of times they require 1 month to 3 months to 6 months before that order can actually take effect. He can also do something President Biden did on his first day, which is reverse or revoke prior executive orders from the prior term. And The thing that I think people have to understand is there's two things an executive order cannot do. He cannot change the law with a signature, and he cannot do anything that violates the Constitution. And we saw both after President Biden and President Trump's first term that the Supreme Court had to step in a few times and say, whoa, 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 this is unconstitutional. You cannot do that. So we have to keep that in mind that just because it is an executive order does not mean things are changing immediately. So we'll revisit that in the Q&A because there's some other details that we have to go on. But that's what we should expect. Monday is a whole lot of executive orders, but they are directives to change enforcement or to revoke things that had been happening before. It doesn't mean things take place immediately. But one of the key agenda items that President Trump had was tariffs and the way they're going to pay for everything. So let's talk a little bit about tariffs. One thing we have to understand is the way a tariff works. A business is not going to be the one that bears the brunt of the tariff. If I'm a company making things in China and all of a sudden there's a 25% tariff on my goods, me, the manufacturer, is not going to pay the tariff. The person in the United States buying it, in this case, let's say it's washers and dryers and it's Home Depot. And I speak from experience because we're trying to get a new washer and dryer installed at our house before new tariffs take place. And guess what? Everything's on back order. So we're probably not going to be able to beat that. But Home Depot wants to buy these washer and dryers from somebody, a country where a tariff is being implemented. China, Mexico, and Canada are three of the primary targets so far. And that tariff is 25%. Me, Home Depot in the US, is going to pay that tariff. Now, Home Depot then has a decision. Do we just eat the additional 25% cost and let it erode our bottom line when our margins are maybe 12 or 13%? Probably not. We're going to raise the price of that washer and dryer by 25%. So a tariff is essentially a tax on consumers. So short term, this means that consumers are going to pay higher prices on foreign goods. Now, the purpose of this, and I'm not saying we don't need to fix the trade deficit, but the purpose of this is to get more stuff manufactured in the United States and to add incentives for people to build stuff in America. That's a long-term thing that has to be done. But short-term, this is a tax on consumers, meaning prices go up. We already just this morning saw something that's going to happen. Canada is saying they're going to issue retaliatory tariffs against US companies and goods and services because, of course, President-elect Trump has said he's going to add a 25% tax on a lot of Canadian goods. And Canada is our number one trade partner. They're our number one person buying US made goods. So now they're saying, well, if you tariff us, we're going to tariff you. And so the trade war, really, the rumblings have already started. I think the bigger issue is this creates uncertainty. We're seeing this, the Federal Reserve just issued their beige book, which is kind of where they ask businesses around the country, what are you feeling right now? Uncertainty towards tariffs was the number one thing that businesses are feeling. They're finding already their supply chains are freezing up. We're finding it trying to get a washer and dryer from LG, which I think is Korean. They're just on back order, and now they're telling us it's till July. So as we learned the last time we had supply chain issues, that also causes inflation. And the other thing we have to understand, because we've remember, we had tariffs from the first round of President Trump. President Biden executive ordered out of there zero. So every tariff President Trump put in place continued all the way until today. So we have the data, and guess what, people? These tariffs are not enough to pay for all the other agenda items, unfortunately. We also learned this will not solve our trade deficit. We already have some hard data. We now have, about 7 or 8 years of tariffs, and we can take a look at the trade deficit. And the way I look at it is as a percentage of GDP. And this is a chart we always show to illustrate the components of our gross domestic product, our economy. And you can see, obviously, consumer spending is a big part of it. Investment spending is the next. Government spending is next. But then you have exports, and you have imports. Now, imports, goods and services we buy from other countries, subtracts from GDP. So that's this orange line down here at the bottom. And one thing that you will see is it's, you know, worse if you look at it by eye than 2017. And the pink line, how much it's subtracting from GDP, is a negative. In fact, I zoomed in for you. If you want to look at it, you can see since 2017, when President Trump started implementing tariffs, we've seen our trade deficit erode more from GDP than it was back in, say, 2014, 2016. So that's a problem. So we have to keep in mind, it's not going to pay for itself. It's going to cost money. It's going to cause inflation short term, and it is not going to solve our trade deficit short term. And this is a 2025 outlook. So I'm not talking about what's going to happen by 2030. I'm talking about short term. We're likely to see inflation go up. We're likely to see the budget deficit go up if these are implemented. And we're likely to see a lot of uncertainty in our economy. So let's take a look at his other agenda items here as we get going. Secure the border. That means, you know, really mass deportations from day one. There's going to be a lot of directives, executive order wise, towards the Department of Homeland Security, the Border Patrol. Everybody's going to have orders on what to do. Department of Justice. There's going to be a lot happening on day one. Boost energy production. We're going to talk about that in a second, because my question is what about the free market? We're going to look at some data on that. Renewing and expanding the tax cuts. Now, the Republicans removed talk of the deficit and the national debt from their platform, although Elon Musk has brought that back to the forefront and saying, hey, Republicans are all about cutting the deficit. So we're going to talk about that in a second here. But first, let's talk about mass deportations. My question is, who is going to work? Because, and I'm not saying we don't have a problem, we need more legal immigration. If you look at the legal immigrants in our country, you could see the percentage of the workforce. 19% of our labor force are foreign-born workers. That does not count people who are illegally here. If you talk to businesses who employ short-term workers, migrant workers, things like that, they're going to have problems. And you look at one thing, one of the agenda items that President Trump promised was he was going to lower prices at the grocery store. He won the election on the economy, inflation, and the border. The problem is, where most of the country lives, a lot of our goods and services come from two sources. One, we import them from Mexico, and President Trump has already said he's going to do 25% tariff on Mexican products coming into the country. The other thing is, unfortunately, that's just the way things are. They employ illegal and legal immigrants to do that. The reason they do that is they cannot find Americans who will work at those wages to help their businesses. So this is a big problem. We got to fix it long term, but we're likely to see inflation because of this policy. We're likely to see lower economic output because of this policy, because we just don't have enough US born trained workers to do that. And that needs to be a bigger picture agenda item. And hopefully that's what we're going to see start happening in the next couple of years. But turning to energy production, my thing that I look at this is, and I've said this all along, the free market is the one who decides how much oil we're going to produce. And apparently, because I'm old now, I watch a lot of Paramount shows, and we started watching Landman, and it's about, you know, West Texas oil and some of that, and it's actually based on a book that was written about the oil fields in West Texas. And one thing that they talk about is the sweet spot of oil prices. And this goes back, you know, throughout time. I grew up in a farming community, and really the thing is, if prices go up, me, the producer, wants to produce more because I can make more money. If prices drop, I actually want to produce less. And so the question I asked, and I asked this before the election as well, was did President Biden actually increase production? Did President Biden himself, the president, do anything to boost production? And I think most people would say, I don't see that he did. But if you look at the post-COVID lows, you could see that production has gone up to the point of we're now producing more oil in the United States per day than we did at the peak under President Trump. That was not President Trump doing anything in 2020 to cut production, and it was not doing anything to President Biden to boost production. Because when you look at it overall, President Biden, over the first 3 years of his presidency in 2024, we had even more oil. We just don't have the final numbers out. President Biden technically produced more, but that's just it. The free market produced, not the president. We're not going to see oil prices drop instantly. And by the way, if we see oil prices drop, guess what US and Middle Eastern producers are going to do? They're going to cut production because they're making less money. They have a sweet spot. And if oil drops too far, they're going to cut it because they want to artificially boost that price again. The free market controls it. Now, there's things at the fringes that can make us produce more long term, but short term, there's no executive order that's going to automatically cut the price of oil. Because if it goes down too far, it's actually going to hurt us long term. So turning to tax cuts. One thing that we ask about is, did the tax cuts help? And I've been showing this chart since the tax cuts happened. And I have an orange trend line that I drew going all the way back to the year 2009. And you could see when the 2001 and 2003 tax cuts finally expired, you could see the little bit of drop and the trend line went going. And then you have to zoom in pretty close to see the trajectory of that line was maybe a little bit better after the tax cuts, but they didn't really help. What changed the trajectory of consumer spending was all these stimulus checks, and for whatever reason, it has not let up. But the trend here did not change too much. Now, I'm not saying I want higher taxes. I'm just saying it's not as dire as everybody makes it out to be. To say if we cut taxes, I'm sorry, if we let the tax cuts expire, we're going to see just a mass recession. Likewise, if we increase the tax cuts even bigger, is what one of the campaign promises were, we're not instantly going to see this robust economy. So that's something to keep in mind. Now, turning towards what I think is an interesting development is this thing called DOGE, which is the Department of Government Efficiency. I love the logo that people have created. They have the goal of eliminating government waste. The original goal was $3 trillion per year. And I think people said, don't you mean over 10 years? And I think they did back that off. Now the goal is about 500 billion, $500 billion of cuts per year. The top idea coming out of there is this to cut federal employees. Elon Musk has said we could really look to cut 50, half the American workforce, the federal government workforce. That would be about 1.5 million jobs, and it would save $150 billion. So you would see it would take a nice, 30% chunk of that $500 billion. The problem I had with this was one of the line items of waste that DOGE put out there was interest expense. Well, that ship's already sailed. We have to pay interest on the debt that we've accumulated from the past year. So the question, by the way, I love this idea. It's something that we should have been talking about for really the last 15 years. Because if you go back, some of you might remember what I called the debt ceiling circus back in 2011. It was the last time Republicans really did anything to cut the deficit. And so I drew a box. This red line here is government debt. And you could see how just crazy the national debt was going relative to GDP growth from 2008 to 2011 when Republicans finally and the Tea Party said enough is enough. And you could see they did kind of change the trajectory of debt, but GDP just kept kind of chugging along. And it's actually at the same trend line that we've had all the way back to before 2011. Now, these red boxes are important for you to understand. This bottom red box here, That is pre-COVID President Trump. And one thing you will notice there is even before COVID, President Trump was increasing the national debt at a rate faster than what we had seen prior to the debt ceiling circus. And the reason that was is the tax cuts were not paying for themselves, and they proved to not pay for themselves. So yes, we need Doge because if we're going to cut taxes, we're going to have to find ways to cut other places. And then you could see just how ridiculously crazy it went up. Even we had the post-COVID surge, but President Trump kept it going, and President Biden just kept his gas on that pedal heading towards that cliff. And you can see this is unsustainable. We can't have debt going up at this rate when the economy is still growing at this rate. So the question I present to Doge is where can they cut waste? And I'm not going to go too deep into this because we spent a lot of time on our pre-election webinar talking about this. But when you look at just federal income taxes, excess tax receipts, this also includes tariff revenue, by the way, you can see we're pretty dang close to running a balanced budget. We're only $113 billion away from balancing that out. The problem is all these spending categories that Elon Musk is looking to tackle, cutting all this wasteful spending, that's fine. We would be having a surplus if all we had to pay for was the things that income tax was designed to pay for. But if you've watched me long enough or been on our website very much, you'll understand that the big issue is entitlement spending. Social Security and Medicare ran a $1.6 trillion deficit. I have not seen Doge talk about that. So instead, this is what we're facing. Here's all of our tax receipts. Here's everything else. We're running a $1.7 trillion shortfall. Doge is saying they can cut $500 billion out of that. So we're still going to be running a $1.2 trillion shortfall if Doge actually gets its way. And you can see interest on debt is $700 billion right now because of the disconnect that we've had. And so looking worse, this is the only places Doge can cut. We can't get rid of interest on debt, which, by the way, this coming year is going to be very close to $1 trillion by itself. We're going to be paying interest close to $1 trillion on a $6 trillion budget. So 1/6 of our budget is going to pay other people for the debts that we've accumulated over the last 50 years. And then you can see Social Security and Medicare. Nobody's talking about it. I was shocked, though. Elon Musk is talking about defense. So that's something we have to keep in mind here is defense spending was always thought to be the holy grail that neither side would touch it. Elon Musk is identifying something that anybody who's been around our military can say is, I'm not saying we don't need a strong national defense, but what we do need is we need to cut a whole lot of waste. And there's all kinds of waste that we can cut in that Department of Defense. But we'll talk about that if the question comes up, because I've talked to a lot of people since the election about defense companies and investing there. I'd say there's a good chance that defense companies could be hurt a bit because of Doge and their focus on cutting waste. Just very, very quickly, why this matters. We talked a lot about this in SEM University pre-election is our economy can only grow if you look at how many people are working, how much are they producing, and then we have to factor in what's our trade deficit and what's our interest expense, because those take away from GDP. If we pay money for interest, that's money we don't have to invest. If we pay money outside to other companies, that's money we don't have growing inside our own country. So final bullet point, what could go wrong in 2025? Obviously, economic growth can slow. Inflation can heat up again. I think that's a very big possibility that we see happening. But I think more importantly is markets just can't meet their lofty expectations. But talking about each one of those individually, economic indicators right now, we're mixed right now. We have a pretty decent economy. It's not great. It's not terrible, but it's decent. We need to see all of these pink and orange arrows flip up to green to support what's happening in the market. But what about inflation, though? We've seen an uptick in inflation already before the tariffs. I think what we're seeing happening is inflation could get worse if President Trump starts implementing those tariffs too soon, if the supply chain dries up. That's important. Market-wise, though, I think what's most important to understand is we've been in a huge, wonderful run for a long time. Going back to 2009, stocks were compounding at 14% per year. That's great, but there's a lot of excesses and they probably need to be removed at some point. And I don't believe that any one president or any one Congress can be the one to stop it. Markets go down when people just stop buying and then they start selling because they're going down. And there's a lot of stocks that are way overextended and probably need a bit of a reset. That's not a bad thing, that's healthy. But we have very lofty expectations that I think are going to be difficult to meet. So let's talk about our game plan for 2025. We're going to just enjoy this trend as long as it lasts. The trend is still up. We're riding that trend as much as we can. That's important to understand is we love these returns. They're not going to be the same as the S&P 500, which by the way, 10% of the S&P 500, I'm sorry, 10 stocks are 40% of the S&P 500. So you do not have diversification if that's your only investment. You're basically putting 40% of your money in 10 stocks. So we are not going to chase manias. We're just not designed to do that. We're going to stick to things that work historically over time. But most importantly is we have an exit strategy. We have a way to get out if whatever happens begins to start hurting stock prices. And that's important to understand because what we follow is this behavioral approach that says long-term the economy is going to, or I'm sorry, the stock market's going to go at the rate of economic growth plus dividend yields plus inflation. That should be a nice steady line. The problem is stock prices over and under anticipate. They get overly optimistic. We're probably somewhere here or here based on what our indicators are telling us. We're way overly optimistic. Doesn't mean it's going to go down immediately, but eventually when those excesses are removed, we want to wait for a better place to get in. We want to have money on the sideline to take advantage of lower prices. Always want to remind people that the stock market's a story of human behavior of overreactions in both directions. Do not let your returns impact how you feel about it because we have a plan. We have a very wide list of strategies. Our most aggressive long-term money is still fully invested in the market, and it will stay that way until the trend is proven to be moving down. Shorter term, our lower risk money is designed to take money off the table more quickly. What I want everybody to leave with understanding is every decision should be based on your financial plan and your cash flow strategy, not who the president is, not what Congress is doing, not what the markets did last month or last year. It's what your financial says belongs in your portfolio. That starts with your financial advisor. Then we can decide where should we be investing. For a lot of people, the last 2 years of above average returns means you actually could afford to have less risk in your portfolio because you just added 2, 3, 4, 5 years to your longevity on your financial plan. But if you lose 50%, which the stock market can and will do, your financial plan could be set back accordingly. And that's something that we have to keep in mind. Finally, I know I'm slightly over time, but I do want to talk about something important. Is Patrick Henry in 1799 said, "Let us trust God and our better judgment to set us right hereafter. United we stand, divided we fall." It's been since the 1930s that our country has been this divided. We saw this during the election. We saw it's really been happening since 2004, but every election we get more and more divided. And this survey that just came out, from Pew Research is basically, Republicans say Democrats are more lazy, more immoral, more dishonest, more unintelligent, and more closed-minded. Well, Democrats believe Republicans are immoral, dishonest, unintelligent, and closed-minded. About the only compliment Democrats gave was they did not call Republicans lazy. But everything else, we do not trust somebody who doesn't share our political beliefs, and that's so wrong. We have to come together as a country. So we can't individually change that, but we can change how we interact with people. We can change how we get our news. We can look for middle of the road sources. We can ignore people's opinions and just focus on the big picture. I think we're going to solve it. But right now is a very dicey time in our country, and we just ask that you focus on things that you can control and try to not get so worked up by somebody who has an opposite political opinion, because I believe we will fix it. I hope it doesn't have to be like we fixed it in the 30s and the 1860s, where we had to have everything kind of unravel and then rebuild it. I see things beneath the surface that people want to start fixing it. So let's ignore what the media is telling us on that. So a little bit over time on that by 2 minutes. I'll take that as a win though, since I started 2 minutes late. Um, I'm gonna start turning it over for questions and answers. If you have to hop off and get back to work or get back to your day, I understand. There is a Q&A button. Please hit that. While we gather that information, I'll start answering some of the ones that came in ahead of time. But as a reminder for anybody who doesn't follow us every day or every week, um, there's a few things you can do. If you're an investor with SCM or you're just curious on your investments and how you should be positioned, we have a risk questionnaire at scmwealth.com. I'd encourage you to follow our socials. We do have a TikTok. We may have to take that off of there this weekend, but we will see what happens there. Um, have an Instagram, LinkedIn, Facebook. We post a lot of things. SCM Market Insights are there. And just as a side note, one of the things that I'm most proud of that we've done in the past year is my daughter and I launched something called Money Talks with Dad, and it's just basically for a way for us to talk about things and, like as she said, explain finance things like I'm a third grader. Because a lot of times people who have made it successfully kind of talk down to those who don't. And what we're trying to do is like just show some grace and talk about all sorts of things like budgeting, some of the things that happen in life, how you plan for that, debt. We haven't even gotten to investments, but we will. So that's on our YouTube channel. We also continue to share it on the socials.